Hello and welcome to Trade Talks. My name is Yogesh. In the latest sign that the American economic policymakers are highly concerned about the coronavirus, the Federal Reserve announced on Thursday that it's going to drop an extra $1.5 trillion on the financial system. The Fed actually made an emergency cut of 0.5 percentage points to its interest rate target just the other week. But it seems the central bank officials think the economy needs extra cushioning against the blows from the coronavirus outbreak. But how exactly will this work in practice, and who will benefit? As you might already know, the Fed is the United States central bank. Crudely put, it's a bank for the country's private banks, and its job is to make sure the financial and banking systems don't blow up, so Americans can carry on with business and commerce. The most visible of these efforts are the Fed's adjustment to interest rates, which also give the central bank enormous influence over the economy and the balance between inflation and employment. This $1.5 trillion announcement is a bit different. To explain it further, you need to know how a repo market works. Repo is where one bank or a financial firm sells a treasury or other asset to another bank or a firm in exchange for reserves with a preset agreement to buy it back at a later date. A repo is essentially a cheap short-term loan, a way to get reserves quick and easy for immediate needs. The bank trade huge amounts of reserves back and forth all the time to settle the transactions that average customers and businesses in the real economy make with each other. But last fall, the financial system suddenly found itself short of the reserves it needed to conduct all the repos people and firms wanted. Interest rates in the repo market briefly shot up way past the Fed's target, causing everyone to freak out and the central bank to intervene. Battered by the damage the coronavirus is doing to global production and trade, plus the oil price war that just broke out between Saudi Arabia and Russia, plus the chaos in the US stock market, the repo market is once again showing the same strains as last fall. To get firmly ahead of the problem, the Fed went big. It announced 3 new windows for repos, all starting in the next few days, 2 of which will last 3 months and 1 that will last 1 month, with each window of repos capped at $500 billion apiece, hence the $1.5 trillion. As a straightforward matter of the Fed's obligations, this move was a no-brainer. It makes a 2008-style financial meltdown less likely, and there's no major downside risk like inflation. The money the Fed is lending is being used to preserve current economic activity, not stimulate more activity. But there's a bitter irony here. Unfortunately, because of how the Fed is designed and the tools legally provided to it by Congress, all the central bank can really do is offer a lot of easy money to protect the profits of big banks and wealthy investors. After the 2008 collapse, Congress actually did give the Fed a new legal tool allowing it to lend directly to help businesses in the real economy to help in an emergency. But so far, that tool hasn't been put to use. In short, it's the rich and the powerful of Wall Street who benefit most directly from the Fed's willingness to act and go big. The central bank can prevent the financial system from coming apart, which is certainly a good thing, but it can do little for the average person's livelihood. Not only is that a galling and unjust situation, but like all trickle-down strategies, its economy value is decidedly limited. Thank you so much for watching this video. To keep yourself updated about the latest happenings in the world of financial markets, subscribe to this channel and click on www.century.ae. My name is Yogesh, and you have a great week ahead.